We need to talk about some scary predictions from some large institutions, but specifically Vanguard has come out with a pretty rough stock market outlook for the coming decade. This person asked a very good question. I've been getting this question a lot recently, so I wanted to jump in on this. Professor G, I look forward to your videos every week. Thank you. Vanguard predicts returns for the next decade will be alarmingly poor. What's your opinion on future returns? I'm retired, living off my investment accounts, and this is concerning. So this is actually something that I brought up with my Patreon group earlier this week because that's where I break things first. That's my exclusive group, and so if you are interested in being a part of that and getting news and highlights from me the second that things happen, go ahead and click the link down in the description, which is my Patreon exclusive group. So here's a bit of what Vanguard put out, and I'll go over this in detail in a second. Some highlights are that US equities are only going to return 3.3 to 5.3% per year. US growth stocks are going to return even lower at 1.9% to 3.9%. And they're saying that bonds are going to return 4 to 5%, so even better than most equities. Vanguard's not alone in these types of calls either. Many big firms are calling for similar negative outlooks, like Goldman Sachs, who said that we'll see a 3% per year average return in the coming decade as well. Not only this, but Vanguard is doubling down in recommending something extremely conservative. Vanguard's recommending investors tilt heavily towards bonds, with a 70% allocation to fixed income, as high stock valuations and historically low equity risk premium point to better long-term returns in the bond market. Traditionally, Vanguard has said a portfolio of 60% equities, 40% bonds is probably the best move, but right now what they're saying is they're flipping everything and going 70% bonds and only 30% in equities. Vanguard's model portfolio, based on the Vanguard Asset Allocation Model, or VAAM, increased its bond weighting by 3 percentage points in July from the month before, expanding fixed income exposure to 70% and trimming equities to 30%, according to the firm's time-varying asset allocation report released last month. The shift moves further away from the traditional 60-40 portfolio split between stocks and bonds. They're basically saying that the longer-term bonds, like 10-year treasuries or bigger, will rise or at least stay put while other equities don't grow very much or maybe even fall. The firm projects US equities will deliver average annual returns of 3.3% to 5.3% over the next decade, compared with 4% to 5% for bonds. Now, to understand where they're coming from, you need to understand this. Here's some of the worst decades that we've seen in the stock market. From 1929 to 1939, that was the Great Depression. The annualized return was roughly -4 to -5%, depending on start and end points. The market crash in 1929 partially recovered, then struggled through the 1930s with deflation and weak growth. This was one of the few decades with outright negative returns. Then we had 1966 to 1976, which was the stagflation era. Annualized returns were about 0 to 2%. Nominal returns were positive, about 5 to 6%, but because inflation eroded those gains, it really felt like 0 to 2%. Stocks went essentially nowhere in real terms for over a decade. More recently, it was 1999 to 2009, which was the dot-com crash, but then also the global financial crisis. This was nicknamed the lost decade for stocks. Annualized total returns was about -1% to 0%. Investors saw two massive crashes during that time, which was the dot-com bubble or tech bust, and then also the 2008 financial crisis. While equity markets do feel a bit overvalued at this point, and they're definitely being driven by the hype between technology and AI, for Vanguard's thesis to play out, we have to see stocks grow at a level that we've only seen in the absolute worst times that we've ever seen in the history of the stock market. But then also, bonds need to hold up and actually perform at a level that they haven't been performing at in even over 20 years. Vanguard says with 10-year US Treasury yields around 4.2%, investors may find more compelling risk-adjusted returns in fixed income. This is all well and good, but we have a huge problem with this assertion. Fed rates are almost certainly going to be cut later this year, and if not, they're going to be heavily cut in 2026. I'm going to explain why this contradicts Vanguard's recommendations, but also we may be in for some heavy inflation and dollar devaluing very soon, so we need to start preparing today. First though, I want to take a second and thank and introduce the sponsor of today's video, Strawberry.me. Strawberry.me connects people with certified career coaches to help them break through obstacles, land better opportunities, and build fulfilling careers. Just like how investing and setting up your retirement future is somewhat confusing and definitely daunting, dealing with the everyday struggles in your career may be equally tough to handle. I enjoy being a business owner and being the boss, but sometimes it's good to just have somebody to bounce some ideas off of. What I found recently is that it all starts with a clear plan and solid direction. It's why I really enjoy Strawberry.me. They matched me with someone who specifically understood entrepreneurship and finance and knew how to help an overachiever like me. The way it works is so easy. You go to their website, take a quick test so they can place you with the correct person, They set up appointments with video calls so you could fit it into your already busy life, and then you just show up and figure some things out. You'll never regret investing in yourself. This is definitely my biggest investment recently. Visit today's sponsor at the link down in my description at strawberry.me/investingsimplify to start your coaching with a $50 credit. So like I said, Vanguard's suggesting that the 10-year US Treasury will rise, or at least it'll be a better place for you to hold your money over the next decade. But we have rate cuts coming. As a basic rule of thumb, the 10-year Treasury usually trends down when the rates are cut. But the actual move depends on inflation expectations, economic growth forecasts, and global demand for US Treasuries. That last one is a big one. As the US faces heat with other nations and global economic power shifts, some foreign central banks are diversifying away from the US dollar and reducing their reliance on US debt. This is not a new phenomenon, but has accelerated in recent years. The US government's large and growing budget deficit means it must issue massive amounts of new debt. Some foreign investors are wary of the US government's ability to finance this debt, especially as the US Treasury has to borrow or refinance trillions of dollars.